everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited that you could join us. We are going to try to help you improve your financial portion of your retirement. We do that by answering your questions. So you can send in questions at any time during the show. Send them into the email address at Talk Money with Tom. You can send them on the chat, whatever works. You can send them during the week. We will not be here actually next week, but we'll answer those the week after. But really look forward to being able to help. We've had a great time with this show. We always start with a summary of what's happening with the market, so we'll do that also. But we believe that the more you know about retirement and retirement planning, asset management, tax planning, the better your retirement can be. Even if you have an advisor, it just allows you to kind of converse, more, higher level conversations with those. And so we try really hard with education within our practice. We feel it's very important. We started this channel for that purpose. You can subscribe to this channel and hit the subscribe button. Little bell button next to it will allow you to get notifications when we put something new on there. So feel free to do that. And of course, you can meet with us if you'd like. Maybe you have a question that's a little bit more detailed and you want to meet with Ethan and I, so you can come in for an appointment here locally. You can call with phone, video, 30 minutes. We can try to see if we can help you. So you go to our website, there's a book appointment button up on the top, push that and you're off and running, and you can pick a time that works for you. So I look forward to being able to try to help out as much as possible. Hopefully there's something today that you can grab onto and use during your retirement. So of course we always like to start off the show with a commentary about what happened in the market this week. And so we have this chart here of the S&P 500 going back to the very top, which was the beginning of 2022. We can see, kind of the blue downtrend line there that we broke through this year. And we're just continuing on, actually. We've had some slowdowns here and some pullbacks and what have you. But if you look at the overall chart, we hit that low back on October 13th. Still doing pretty well.
Yeah, and this week's kind of like a low volume week with a lot of people on vacation.
Yeah, and not a lot happening. It's only a 4-day week, as far as the market goes. Obviously, and a half, actually, I guess it's a 3.5-day week because it was a half day on Monday. But there are a few things that have happened that have been significant. There's, number one, the minutes for the Fed meeting came out. And really, what was surprising about the minutes was that the decision to pause rate increases in June, which is the first time they've paused rate increases in 15 months, was a unanimous vote. So that's what you heard about. But when you see the minutes, you realized it was more of a 50-50 argument as to whether they should raise rates or pause. And so there was some, I guess some consternation. The main concern, and just keep in mind, the Federal Reserve's job is a dual mandate. It is to keep what they call full employment. Mm-hmm. That's definition is very squishy, to say the least. But nonetheless, also to have a 2% inflation rate. Now they're looking at core PCE inflation, mm-hmm. personal consumption expenditure inflation, which we've talked about several times on the show. But nonetheless, the factor that we watch for is what they're doing with the interest rates. And so in the past, one of the problems with the Fed is that they've raised rates too far, and it's brought up something broke. Lehman Brothers failed in 2008 happened. We brought down the market in 2000 from the irrational exuberance of the dot-com with 19 rate increases and all these types of things, right? And so that's what the market's looking at now. So when they see the minutes saying, hey, these people are still thinking about raising rates, at least, close to half of them, when a pause was really what was expected. So that was interesting. But then on top of that, we got the ADP private jobs report, mm-hmm. right? And so ADP is a big payroll system, and it's kind of a neat report because basically they look within their system and say, well, how many new people are on the payroll system in total? So not just like new companies they signed up, but existing companies, how many new employees did they add? 497,000 new jobs created in that system in June.
Yeah, and this is it shook the market, you could say.
Yeah, exactly. The market fell yesterday and what have you. And I said in yesterday's video that I don't see that as a bad thing. every time that happens, and it was actually a big jump over expectations. Expectations were half of that, so doubled That's a big deal. But every time that happens, the market drops. And it's because the market is looking at it and say, oh, that's going to give the Fed more reason to raise rates. If they keep going with rates, they eventually could go too far, slow things down too much, we get the hard fall, right? At the same time, one of the reasons they're raising rates is because we have inflation. And one of the areas that we have probably the most inflation really is the service sector.
Yep.
Now, the service sector uses labor, right? What, 4 out of 5 Americans that are working are in the service industry, right? And so what happens then is if you're not able to hire new people, I mean, it's a great example. I have a restaurant. There's a line around the corner. I can't get enough cooks and waitresses and waiters and busboys and those type of things. So maybe I can increase my prices, to kind of keep the line down. I could make more profits during that period of time versus I'm able to fully, staff my restaurant, and now my line is, shorter. I can't really increase the prices, right? So if you can't hire people, so new hires are super important to bring down inflation in the service industry. And so seeing, job growth like that, I think is important. Now, this does rely upon the Federal Reserve, being at a place where they don't have to raise rates so far that they do end up breaking something, or we end up with this hard landing. So that part of the story is still to be told. So today was another jobs report from the Department of Labor. And so this jobs report showed 209,000 new jobs created. And they're looking at different companies and what have you. We won't get into the weeds of that too much, but what happens there is that was less than expectations.
Yeah, I think the expectation was about 244,000.
Yeah, and so that's actually kind of surprising because usually when the ADP report comes out and it's high, the Department of Labor report comes out and it's also high. And that was the expectation this morning. The futures market was down, overnight, probably because of that expectation. It actually came out low, which is, I don't know if it's come out lower than expectations this year.
It's 15 months in a row that's come out above expectations.
Yeah, isn't that funny? So this is one of my themes right now. Expectations are too low, right? I mean, think about it. You look at the first quarter earnings. I think almost 80% of companies beat expectations. You look at what happened with yesterday's job report, and so Wall Street, the analysts, the different economists that are out there are all expecting less than we're actually getting. Now look at this is why I always watch the price in the market and why this chart's so important. The S&P 500 during that entire time frame of pessimism that's been going on since October 13th of low has continued to grow. So the S&P 500 has been right, even though all of those other analysts and what have you have been wrong, right? It is better at projecting what's going to happen. One of the reasons that the S&P 500 is in the leading economic index, the LEI, which only has 10 indicators in it to make that basket, one of them is the S&P 500, because it does have some good predictive power. So here it is. It's still hanging in there. Still have all of these people talking about how things are going to fall apart, and they might be right. So just maybe the timing's off. Maybe it's later this year, maybe it's next year, whatever happens. Yeah?
Yeah, and a lot of people like this 209,000 job report because it's kind of that sweet spot. You want to be growing your labor force, but you don't want to be going at 300, 400,000. And it's kind of nice. A lot of economists say this is where they kind of want the economy to be, and that allows the Fed to have a soft landing.
Yeah, and you were mentioning that the one big negative in that report was the wage growth.
Yeah,
right?
It was 4.4 instead of the 4.2 that was expected.
Yeah, and so that what they're talking about is that year over year, so this June versus last June, wages are 4.4% higher than expected, and expected was 4.2, but nonetheless, that's a big issue too, because obviously it's one of the things that drives inflation is the wage growth. We have to keep in mind, though, all the time, and it's hard to do because it's a huge issue, is that wages, labor markets, all those are lagging indicators. The S&P 500 is a leading indicator. And so if you base your investment decisions on what's happening in the labor market, you're probably going to have some problems. Because I remember even my grandmother asking me one time, why is the market going up so much when there's so many layoffs happening and unemployment's growing? It's because the market's looking at that next cycle, right? And the next cycle, when everything's happening in the labor market on the downside, is usually an upside. It just, the reason the lags there is pretty obvious. It takes time. If I want to do a layoff, you can't just do it tomorrow. Theoretically, it takes steps to go through to figure out who to lay off and what package you might have. If I'm going to hire, it's the same thing. Who am I hiring? You know, what's the job recs? Get it out there, those types of things. So there's always this lag in the labor market. And that's why even the wage growth issue can be, you know, a little bit misleading in terms of as an investor. As an employee, that's different, right? I'm looking for a job, or my son or daughter's looking for a job. Okay, that's an important statistic. But in terms of looking at what might be happening to the stock market in the future, be careful about putting too much weight on what's happening in the market. And the reason the market looks at jobs right now more than normal, it's just because how it relates to the Fed. You do want to look at what the Fed's going to do. They are a very powerful force in this, you know, stock market growth or lack thereof. I mean, that blue line connecting all those high points in 2022, and the reason it was coming down has a lot to do with the fact that the Fed raised rates nearly 5% last year, which is a big jump, and, you know, on a nearly historical basis. So altogether, things are still hanging in there. You can tell this market still wants to go up. We are in a bull market. We have a 20% gain from the bottom. In order to break that we'd have to break a new record, okay? In order to fall back down and fall 20% and get back into a bear market, we're 8.5 months into this. The shortest bull market is 2 years. Anything can happen, right? But I think that there's this positive that's happening. And one of the reasons that people are missing what's happening so far is the positives are bigger than people think. This pent-up demand and this motion to get out there and do things is really kind of offsetting some of these other areas, right? And so I don't see that stopping right away. I see some kind of, you know, weak areas happening. There's probably a recession already happening in the goods market, the factories, even the retailers are starting to see some pullback. Because, you know, those are people buying goods, right? Services are restaurants and hotels and airlines and those types of things. So, and that's what's happening. Now, I do want to spend a little bit of time talking about something we don't talk about very often, which we probably should talk about more. That's just the bond market, because, you know, right now, a little bit over 60% of our assets within the practice are in stocks, but the rest are in bonds and money markets and things like that. And so it is an important component. It depends on which portfolio you have. So if you have a 20% stock portfolio, the bond market's actually more important to you than the stock market. And so this is going back to essentially the same timeline, beginning of 2022. Big drop. Happens to bottom out at almost the same time as the stock market. So if you look at that bottom, that was October 20th. Stock market bottomed out October 13th. So similar pattern, but again, if we go back to S&P 500, that's where it breaks down. You see it kind of was wandering around, and then it took off. And if you look here, didn't take off. It's still kind of going sideways all year. Now, this is just the price movement, and this is one, you know, ETF. It happens to be a big one. This is the Vanguard Total Bond Market ETF, BND. I use this as a proxy to look at the bond market. It doesn't include everything. It doesn't have high yield bonds. It doesn't have ultra short term bonds. But I think there's 7,000 holdings, 4,000, one of those two holdings. I know it's a big difference, but it's a pretty good representation. And so here's the things that are important to understand about the bond market. Number one is last year was a disaster for the bond market. The bond market reacts to interest rate changes. When the Federal Reserve raises rates as much as they did last year, the price of bonds are going to adjust downward. And the whole banking problem that we had was at least partly attributable to the bond market decline. Because if I buy a bond at $1,000, what they call par value, and I'm a bank, right, and it falls to $700 because they raise rates, banks are required to mark to market now, which means they now have to count, didn't used to have to do this, but they now have to count that as $700 and not $1,000. Used to be able to keep it at par value. Well, that means that their capital requirements, they're keeping this for capital, right? the requirements are now not sufficient. They got to go
Yep.
out and get money. Silicon Valley Bank went out to try to raise in a secondary stock offering money, and that created the whole cascade for them because people were wondering, well, why do they need money? Well, this is why. I remember seeing an article last year that said that the 10-year Treasury, which at that time was down to about 24%, was the worst downturn for the 10-year U.S. Treasury since 1783.
Yep.
Right? That's pretty dramatic, right? And so this is an important component. The bond market is significantly bigger than the stock market. I remember an analogy once that said if the stock market is a baseball in relative size, the bond market is a basketball, right? Just to kind of give you an idea of the difference. And so the bond market is not super excited about what's happening here because inflation is still kind of hanging in there. The Federal Reserve is still talking tough. They're still talking about 2 rate increases.
Yep.
We look today, the market is priced in nearly, 92% likelihood of an increase in the next meeting, which is here in the 3rd week of July. And no other increase for the rest of the year is priced in for the market, but the Fed says they're looking at 2 increases. And so the bond market's going to have a hard time taking off in this environment where the Fed is continuing to at least talk about raising rates, right? Bond market, ironically, at least in a price standpoint, does better if there's a recession because they'll probably be lowering rates and then the bond values go up. And if you look back at what happened in 2020 when things were falling apart and the bonds were doing quite well because they were lowering rates down to 0. And so that was a play. As a matter of fact, we were investing in long-term treasuries in April of 2020 and did okay with that because it was a fairly obvious play that was happening. So I think the bond market's going to continue to kind of waffle a bit here for a while until we see what's happening. I also feel, and I've said this last show, I'll say it again, the big talk has been about the recession that's coming. I think that the talk we'll be having more of will be about the inflation that's still here.
Yeah, I think the Fed says if there is a recession, it'd start in October and last till March.
Yeah, exactly, and that's still possible. How does that really impact you? It has to do with how severe the recession is. Is it a slight recession? Is it sometimes that recession you can't even tell? Sometimes you really can tell, like 2008. How does that impact the stock market? How does that impact earnings? So there's a lot of things that we still have to see and how that's going to play out. And again, if we look at what's happening with the S&P 500, it's quite optimistic about how things are going to work out here, at least at this point. So anyway, that's kind of the summary for what we saw happening this week. Stock market continues to do well. Bond market's kind of going sideways. I don't know that the bond market's going to have huge runs here until the Fed settles down, kind of gets things going. Inflation will be the bigger conversation. I get a feeling that we're going to get some report here coming up in the next 3-4 months that where inflation has actually gone up a little bit more, and that's not really expected per se either. So I could be wrong, but I just looking at kind of the feeling for what's going on out there, I think that that's possible. So we'll see. Nonetheless. That's what's going on. I appreciate you joining us for our summary here. I look forward to...
do you want to quickly go over the signals?
Oh, yeah. Let's talk about signals. I forgot about those. So for the signals for the stock market, we're still green on both signals. And so that's pretty obvious by the chart. You can see why. So even for the fast, shorter term things that we do for the IRAs and those types of things, we're green, and we've been green since, I think, May 10th or something. And the slower things that we use for the taxable accounts where we don't want to make so many transactions is still green. But the bond signals have changed, and that's pretty important to understand. Because of all of this, high job growth, the Federal Reserve's conversations, raising rates twice, Fed governors coming out, talking negative, we've actually gone to double red on the bond signals. And so, for double red, that just means that we're going to a point where we're getting very defensive. T-bills, inverse positions that go the opposite direction of the bond market, for example, just to kind of protect that portion of the asset until things play out. Again, to me, that means, again, there's more likelihood that we'll be talking about inflation not coming down as fast or being sticky or even going up. And I think the bond market is sensing that also, and that's kind of what we're seeing here.
Yep.
Yeah. Yeah, thank you for reminding me. All right, thank you very much. Well, again, we'll talk to you again in another summary in a couple weeks. All right, so what questions do we have?
What's the difference between the ADP and the Department of Labor employment report?
Oh, that's timely. So ADP report and the Department of Labor, they come out once a month. They come out right next to each other, usually Thursday or Wednesday for the ADP and Friday for the Department of Labor. They report for the previous month's job growth or lack thereof. It can go either way. And so they're quite important to understand, especially in an inflationary environment like this, what's happening. So the ADP report came out and it was quite high, right? And so what's the difference? Well, with ADP, it's a payroll system, right? They're looking at privately owned companies. They have more exposure to smaller companies as far as that goes. It's weird because for me, the ADP report, I think, holds more water, but for the market, it's definitely a Department of Labor report.
Yeah.
And it definitely responds more to that. Then the Department of Labor report includes what? Government jobs.
Self-employed.
Self-employed. And it's done on a survey basis.
Yeah.
Which, to me, I don't know. Surveys... I don't know, ever since...
There's always a sampling error of some sort.
There are sampling errors, and people answer, Hillary Clinton was supposed to win, in 2016 based on the surveys. So you kind of wonder, people, what they answer versus the ADP where they're looking at actual payroll data, right? It's the same type of thing with rents, right? If you look at rents in the CPI, they're using, these surveys, they go through. Versus Zillow has a report that shows current rents. I think the Zillow one's pretty interesting. It's just a different variety of things. They usually correlate fairly well in the end, over a period of time. But it's just one of those things where, there's some difference, and big difference this week. In terms of the report.
400,000 is a big difference.
Yeah, that's a pretty big one. So, yeah, that's a good question to kind of, dig into. But it's probably just more of the overall pattern. Are we having a lot of growth? Are we beating expectations on that growth? Are we not? Is it growing slower? Actually, the Department of Labor number was probably right where you want to be, a little bit less than expectations, and and still have the growth, right? That's still a lot of growth, a lot of jobs.
You also want to look at that wage growth too. That's another thing that's a big factor. I think that's what people are putting the emphasis on more.
Yeah, because this is an inflationary environment. So what they're worried about is what's called the wage growth spiral, where wages have to go up because employees are going to their employers and say, things are costing me more, I need more money. They raise wages. And when they do that, the cost of the company goes up. They try to pass that along to the consumer. And so then all of a sudden things cost more, and then the employees are coming back again saying, I need even more money. And that's what happened in the 70s. It hasn't really happened here yet. We've had a lot of job growth without tons of growth. I think the average is around 3.4, 3.5% on the Department of Labor, report historically, and we're at 4.4, right? So a little higher, but not spectacularly higher, considering how many jobs have been created this year. Should be higher, right? And I've heard that from a lot of different economists. They're kind of stunned by how low the wage growth is versus how many jobs are coming up. So that's a good thing. I
don't think ADP ever revises their numbers, but I know the Department of Labor Employment always revises because they've revised the April and March data too.
Some of their revisions are stunningly big.
Yeah.
To the point where it's like, wow, why bother with the actual report? I mean, one of those revisions was somewhere in the neighborhood of a 30 to 40% revision down.
Yeah, I think they revised April and May, I misspoke, but I think they revised down 110,000 jobs.
Yeah. So a report, 400 and it's really 290. Okay, well that's a big difference, honestly. So I was a little surprised by that. So it's probably not that easy to get those numbers right and what have you, but still, it would be nice to get the right number, when it comes out. But that's not the way it works. All right, what's our next question?
Are annuities a good income source if you don't have a pension?
Are annuities a good income source if you don't have a pension? Okay, well, let's let's break down how you get income out of an annuity, and so we can kind of answer that in different ways. So first of all, one way to get income out of annuity is what's called a systematic withdrawal, where you just start getting money out of it.
Yeah.
You say, I want, 100 a month or 200 a month or 3% or, whatever it is. And they usually will allow, without any penalty, up to 10% if you're in the penalty period. So that's not a problem.
Yep.
If you're outside the penalty period, if you have one, then, you can take what you want. If you're going to do systematic withdrawal, I wouldn't use an annuity for a couple reasons. Number one, you could, if I had money in this taxable account over here, let's just say in some Vanguard funds or ETFs or something, versus this annuity where I can maybe buy even those same kind of Vanguard, funds inside that annuity, or similar ones, then, the ones inside of a regular account, just a brokerage account, we call it a taxable account, it's cheaper.
Yep.
Because the annuity has a lot of internal costs. It's a lot higher, right? So if I'm going to just do a withdrawal, I might as well just do the withdrawal out of the taxable account, because it also comes out anything I have to sell to do those withdrawals as a capital gain. If I hold on to it for a year, it's a tax advantaged capital gain, right? Long-term capital gain. Whereas anything that comes out of an annuity is ordinary tax, right? So if I'm going to do a systematic withdrawal, right, which has no guarantees, there's just like any other thing, I'm going to look at, a regular taxable account over an annuity. The only advantage of an annuity in that scenario is I can make changes to those accounts, those portfolios. I can buy different Vanguard things or different investments that are involved in those, and without having to account for taxes, versus any changes I make in that taxable account they're going to have to count. So, but I'd still choose the taxable account. Better taxes, less cost. However, with an annuity, you can get a guaranteed income stream.
Yep.
You cannot get that with anything else outside, with a regular account outside. And so those guaranteed income streams, you can get them for life, you can get them for joint life if you have a significant other, you can get them for periods certain, plus life. So I can say, okay, I want to get this for 20 years or the rest of my life. If I live 25 years, I'll get it for 25 years. If I live 15 years, I'll get it for 15 years, and my beneficiaries will get it for the other 5.
Yep.
And usually with the period certain, if you look at it, you're getting your money back in that time, right? So that's good. So, because one of the problems with a life only is that once you choose that, it's the highest payout of those options. But if you pass away, the money it's gone.
Yeah, whatever you put in is gone. There's nothing to give to your beneficiaries.
You could give $500,000. When you get a guaranteed income stream for an annuity, your money is what they call annuitized, and it disappears. You don't have it anymore. And so, $500,000 annuitized, you're going to get this payment for life. That's great. You live 2 months, die, well, that's it. Insurance company made out. And so the insurance company is making the bet on how much they can make based on your life expectancy and those types of things. So then it becomes really important. What are your beneficiary situation? Do you have significant other? What's the scenario as to which choice you get? And so if you want to make sure you're getting your principal back, you take one of these period certain, options, and there's different names for that, but they pay less, right? Any more guarantees, you get less income. It can be a good replacement for a pension. In that regards.
You take yourself out of the market, essentially.
Right. Yeah, and there's some validity to that. Probably the cheapest way to do that is what's called a single premium immediate annuity. They tend to pay better, have less internal costs, those type of things. So you just basically would take that 100,000, 500,000, give it to the insurance company, it immediately disappears, and you get an income stream just like a pension for the rest of your life, or period certain, or whatever it is that you chose as an option. And so that's probably the best way to replace a pension. But if you already have an annuity that is sitting there growing, hopefully, over a period of time, then you have some options. You can annuitize it. You can get an income stream to basically act like a pension. And there's nothing particularly wrong with that. But again, you got to consider potentially your beneficiary situation as to what
and also
would work
your
there.
inflation.
Yeah.
If you pensions and some annuities do not have any kind of inflation or cost of living adjustments, and so
Yeah.
you could be falling behind over time too.
Yeah, exactly. That's where the systematic withdrawal has some potential advantage, whether it's an annuity or a taxable account, because you're not, the money's not disappearing. It can still grow. If you're going to take it out for 20 years, you could theoretically continue to grow your. I mean, let's say you make an average of 7% a year growth. Uh, you could continue to get 7% more money per year and help you keep up with inflation and still end up with a similar situation in the end. So that's the advantage of systematic withdrawal. There are some variable annuities out there and some variable annuitizations. So there's a lot. I mean, unfortunately, this is a generic question about an issue that has 50,000 answers.
Yeah,
literally.
every annuity product is unique in its own regard.
Right.
They set up so every contract is unique, so it can get very confusing very quickly.
Oh, very quickly. You can say, "Oh, I have a Jackson annuity." Well, that doesn't mean anything because Jackson might have literally over their history 1,000, 2,000 different contracts, and so we have to look at the contract itself because it is a contract with the insurance company, and your contract might differ from the person that bought an annuity from the same company just a few months later because they changed the contract, and they're constantly making changes. They used to have some pretty good guaranteed income riders. Those got kind of wiped out in the 2008 downturn because they were a really good deal for not such a good deal for the insurance company and a good deal for the consumer. And for those people that had that they're still out there, they're still guaranteed, but they're not really offering those any longer. So that's just that's how these contracts change based on basically what's happening with the market and whether it's working or not for the insurance company in the end. I mean, they're not in the business to lose money. They're in the business to make money. And so they're going to make the contracts work for them. However, it's also competitive. So they got to make the contract work well enough for the consumer that they get new money coming in.
Yeah.
Yeah. So it's a good question. But it's hard to answer specifically. It is contract driven, and just be careful with any generic comments on annuities. They can be misleading for you specifically. Yeah.
How does commercial property affect the broader economy? I keep hearing about defaults on these big properties, these mega hotels or these commercial buildings.
Yeah, that's a really good question, because I was up in San Francisco for a conference, about a month ago. It was pretty stunning. I mean, the area that I was in, we went, to eat and walked about 6 blocks, and I'd say half of the stores that I walked by were closed. And so some of these cities are getting hit pretty hard. Some of the, remote work that's happening. I heard a report today that 28% of companies have some form of remote work. So still not the majority, but it was prior to the pandemic at around 7%. So there's a lot more people not using these buildings. We certainly see it in our own office space here. We don't use it as much as we used to because we're on a remote work schedule also. And so what's happening is you've got this situation where a lot of these loans are coming due and they've got to refinance them. And because of what's happened with the banking system, the regional banks have a lot of exposure to commercial real estate. They're the ones that got hit in this last downturn with the banking. And so that's where it ties together. If these new commercial projects or existing commercial projects with debt that needs to be refinanced, if they can't get new money, you're not going to have new commercial projects, and you're going to have some defaults and problems on existing commercial projects.
Yeah, I know that now businesses are going and requesting that if I guess whoever's renting out the space, they're requesting a guarantee even if they default on their whatever existing debt payments, that the person can still have the space, the company can still have the space just to protect themselves.
Yeah, interesting. Yeah, I guess it's becoming a buyer's market, right? I mean, just because of what's happening. So how does it impact the economy? Well, if you're a regional bank and you've got some bad debts coming up on some of your other commercial properties, you now have this capital requirement issue because the bonds are falling, and the Fed did step up, or the Fed Treasury / FDIC stepped up and created a backstop environment where you can, borrow money against the value of your par value of your bonds, which is good. gives some liquidity. But what you've seen is these banks can go out of business overnight. So there's got to be some serious fear here about letting capital go, right? So capital's going to be more restrictive already. And so I think that the commercial property situation is going to just exaggerate that. That's where you get less flow of money. Matter of fact, the Federal Reserve talked about the banking problem being sort of like a rate increase, where it'll slow down the economy. So if there isn't as much money flowing through these regional banks in the form of loans, partly because commercial properties are suffering, that's going to affect the economy. How much? So we need, ironically, some things to affect the economy to slow it down some, to try to bring inflation down. So there's nothing wrong with that up to a point, right? And there's a tipping point, and that's what everybody's basically looking at. You know, we're still not at that tipping point, there's no doubt, but we could get there. And so if you get enough things slowing down, all of a sudden you're tipping over into a harder recession, and you get that hard landing and what have you. And so, and these are the things that are the real issues. And this is a great question, because you get to the heart of the big issue of what people are afraid of here in this market, which is just kind of what happened in 2008. You keep raising rates and things are okay, and then all of a sudden little things start to happen. And so would the government backstop all of this commercial property? Probably not. And so then it becomes this situation where you could have this kind of cascade. And so, you know, we'll see how this plays out and how bad things get in that arena. But it's something, you know, definitely worth watching for. So far, it hasn't been an issue in the totality that it would cause significant problems. We're still seeing economic growth. We're still seeing the things that we need to see, but it is a precursor to something to watch for. But that's how it kind of comes through the banking system and creates, you know, less projects and more defaults on that area. So, you know, we'll see. There's always people out there willing to buy distressed properties, so that could help in a liquidity standpoint.
Yeah, Apple has picked up a couple buildings in the Silicon Valley that have come up for sale.
You know, when you're sitting around with $100 billion in cash, that's what you want to have when things are getting cheap. You want to have some money, and so yeah, exactly. You might be able to step in, and so there's liquidity that comes in, but it doesn't come in at the higher prices or at the normal prices. It comes
they gotta get a discount to come in.
Yeah, exactly. That's a good point. All right. What else we got?
Where do you go when the bond signal turns red?
Where do you go when the bond signal turns red? Okay, so let me pull up that chart, actually. Let's get back to that real quick. I think it's interesting. So here's the total bond market. You know, you can see it's not doing terrible. Yeah. But you can see why it turned red for us, that little tail there here that's happened recently. And it's actually even broken through a little resistance point there where it kind of, you know, was at a low and then came back up and it broke that. And so when you get into kind of red signals, for us, the way we handle red signals is we get quite defensive. And again, in our fast signal, that'll turn red, you know, and get back to green pretty quick, potentially. But we don't have to worry about, we don't have a trading cost, a commission to buy and sell an ETF. So, and in our fast signals, we use it for accounts that don't have taxes either, like IRAs, Roth IRAs, you know, 401ks, those type of things. And so we will move to T-bills, right? And that's our default position for a red signal, even for the stock market. And we will move, in the case of bonds, we will also go to an inverse position, which is basically buying something that goes the opposite direction of the bond market. Different segments. The 7 to 10 year treasury, the 20+ year treasury, the high yield bonds are three that we use as a short position, where when the market goes down, we make money on those positions. So the slower signals are made for our, you know, taxable accounts. Don't happen as often. That just changed yesterday. And so that's what we do. And so we get defensive, we wait it out, and again, unfortunately, the bond market is the side of the equation that is supposed to be the safe haven. Right? That hasn't been true this year. A lot of these are down a little bit for year to date, the pieces that we look at versus the stock market, which is definitely up year to date. So that's our outlook on it and how we kind of make our changes as far as that goes.
So when do I make a transition to a second career that's doesn't pay as well but is way better or way more enjoyable and better for me?
Okay, second career, more enjoyable, less pay. Okay, so let's think about that. There's a couple things, and obviously that's one of the problems with these question shows. We don't get to ask. Maybe we'll get some of these on. Some people come on here, and we'll go back and forth because first question I have is how much less pay. Mm-hmm. So I'm going from $500,000 to $20,000. Ooh, okay, that's a big jump. I'm going from 100 to 80. Okay, that's not as big a deal. So you got to factor in, how much of a drop you have. The second thing I would ask is how much resources do you have? Are you basically dead broke and you're going to have to, radically adjust your lifestyle because you're making this big drop down? Because the reason I would look at that is because now I'm trading off things. So I'm trading off this job I don't like as much for another one that I like more. But now I don't really have enough money to do the same things I used to do. So I'm maybe giving up some things I like to do, right?
Yeah.
And so I got to make sure that mental trade-off works for me. Like my job, I spend a lot of time in that. But because I'm making less money and I don't have the resources to kind of keep all these other fun things going, I'm going to have to cut back on some of my fun things. Mm-hmm. So see, that's why this question is kind of got a lot of angles to it. If you have enough money, then you're just moving to a more enjoyable job, and then your other money is going to kind of come in, and the earnings from that money is going to support you along with that job. I guess you'd call it like a semi-retirement.
Yeah. I think in the FIRE movement, it's called barista FIRE. The idea is you take a low, stress, kind of like a more, lower paying job, basically just get you health insurance, kind of avoid that cost. And then maybe you have some money that you can throw in retirement accounts, but otherwise you're kind of just independent for that.
Yeah. So that's how I'd look at it. What's the drop? What's that drop mean? How's it going to affect my lifestyle? Is the new, more enjoyable job going to offset any potential negatives to my lifestyle because that job pays less? Do I have enough resources to avoid that? It's a good question. It's really interesting. One of the things we can do in that case is, this is one of the cool things, we try to keep our financial plans up to speed. We link them in so that they're updated, on a regular basis. And so when somebody calls us and asks us a question just like that, we can put it in. We can say, okay, let's look at this. Let's put those parameters into the plan and see what happens. So we can run one plan, shows existing job, existing income, existing savings rates, whatever might be happening. And we can run another one with a lower paying job, maybe lower savings rate, maybe no savings rate, that type of thing. And what happens? Does it still work? How much impact does that have on your future financially? Because there is this kind of, need to be in a job that you like. But at the same time, you got to be careful what that means. How much offset do you have? And a lot of people stay in jobs they don't like because the offset's too big, right? So anyway, looking at that in a planning situation where we can run a Monte Carlo scenario on it and say, okay, hey, that still works pretty well. You have enough resources to kind of maintain this lifestyle that you've described, or wow, that's pretty disastrous. You're going to have to change your plan completely, retire much later, whatever it is, right?
Yep.
And we get to see what that offsetting, cost is to taking that lower paying, more enjoyable job. But it's a good question. So, all right, well, that's good for today's show. I really appreciate everybody coming and listening and, contributing questions. Again, we will not be here next Friday. Be out of town, and we will be here 2 weeks from today. We'll do the show. So please send any questions that you have here to, ask Tom at talkmoneywithtom.com, and, give us some time to prepare for them and what have you. It'd be great. And, we can answer those questions for you. Obviously, visit our channel. You got a week off here with no show, so you can go visit the channel. I think we have probably 1,200 videos on there now. And, you know, subscribe to the channel for us. We're really making a big push to try to get new subscribers, of course, and hit the bell button for, you know, notifications for when we put new content on there. And then lastly, of course, is just, you know, feel free to set up an appointment to meet with us. Sometimes there's things that, you know, are more complicated than you want to bring up on a show. And so we're happy to meet with you for 30 minutes and talk about your particular issue. So look forward to seeing you again in a couple weeks. And thank you very much for joining us today.